All right. Welcome to greenhouse gas verification drivers and types. If you're not already familiar with us, Sustainable Business Council is a member based organization. Our mission is to accelerate the adoption of sustainability by integrating it into business strategies and operations, driving long term impact. Today, our focus is going to be on greenhouse gas accounting and verification. We'll start with a little overview and introduction to accounting and verification, then look at some verification drivers, and wrap up with how to prepare for verification. So, first of all, this may be familiar to a lot of you, but we find it helpful to start with defining some basic terms. So, a high level overview of greenhouse gas emissions. Greenhouse gas emissions are commonly broken down or referred to in three separate scopes. Scope one emissions would be direct emissions from sources owned or controlled by the reporting company. So, that would generally be on site emissions. Scope 2 emissions are indirect emissions generally related to energy use, primarily electricity, but can also be heating, cooling, or steam. And then finally, Scope 3 emissions are basically everything else. Indirect emissions related to activities by the company, looking upstream and downstream of the company's activities specifically. So scope one emissions, scope two emissions, and scope three. Often scope one and two emissions are sort of lumped together under an organization's emissions, and scope three is treated in a bit of a separate category as value chain emissions, meaning emissions upstream and downstream of the company's direct activities. Next, we'll talk a little bit about greenhouse gas accounting and verification. So, when we talk about greenhouse gas inventory and accounting, I do think of these slightly differently. Essentially, when I think of a greenhouse gas inventory, I think about what's being included. So, facilities and emission sources primarily, but it's really how you decide what to include in your emissions accounting practices over a defined period. That's generally one calendar year. It can be a fiscal year, depending on your organization, but generally these are the defined period is a calendar year. Greenhouse gas accounting is the process by which you measure or calculate your greenhouse gas emissions. So sometimes you'll see this referred to as estimating. That's because most companies don't actually directly measure greenhouse gas emissions. You usually measure or keep track of the activities that produce greenhouse gas emissions and then use established methods like an emission factor to estimate or count emissions related to that activity. So, a few best practices in greenhouse gas inventory and accounting. First, align with an accounting standard. The Greenhouse Gas Protocol is internationally recognized as a reliable greenhouse gas inventory and accounting standard. ISO 14064 is also a relevant standard. Recently, there was an announcement that the ISO standard and the Greenhouse Gas Protocol will align. They largely align already, but there's some effort underway to streamline that even further. Uh, Next would be to establish clear and consistent boundaries. So that would include defining and documenting your organizational boundaries. The Greenhouse Gas Protocol defines that as being operational control. So you actually have control over the operations resulting in greenhouse gas emissions. That can be financial control. So maybe you own the activity, even if you don't operate that activity or equity share. So if you have partial ownership in an operation that results in greenhouse gas emissions, you would account for the fraction of greenhouse gas emissions resulting from your ownership piece. Uh, and then operational boundaries. So that might include scope one, two, or relevant scope three boundaries. That all defines what gets included in the inventory. So, a couple things to remember here. One, use the same approach every year. So, don't include something one year and not include it the next year unless you have an explicit reason that is documented. Next would be ensure that all relevant sites, facilities, and emission sources are included. and align with the requirements of your selected standard. Again, using that same approach year over year. So if you take an operational control approach one year, make sure you take an operational control approach the next year, or vice versa. If you intentionally choose to change your approach, just make sure that gets documented. Next would be to use reliable activity data. Essentially, what this means, a couple things. One, use the same data sources year over year, making sure that those data sources are reliable, accurate, and reproducible. Sometimes companies will be really eager to establish a reliable greenhouse gas inventory, and so end up using methods that aren't very reproducible or reliable year over year. So it really pays to invest in the front end to make sure that the methods you're using are going to be available to you year over year. Likewise, implement quality control practices to make sure you're catching any input errors. So, this is one that we see even with greenhouse gas accounting software. If you don't have a lot of hands on involvement in how emissions are accounted, really make sure that you're focusing on input and quality inputs. Keep in mind that even energy bills can be wrong sometimes. So I've heard companies using best practices in which they have processes to flag abnormal inputs. Again, even things like getting the wrong energy bill or having an error in your energy bill can really cause problems and headaches later on. So use reliable activity data and have processes in place to verify the reliability of that. Next would be to apply emission factors correctly and review them annually. So your emission factors should be current. So make sure you're updating annually or whenever methodological changes occur. As an example, the EPA publishes emission factors that are updated annually. That doesn't mean that they change every year, but they're reviewed every year. So make sure you're using the most recent emission factors available and document your sources. Next, make sure that your emission factors are appropriate for the activity. So, as an example, vehicle emission factors from EPA are specific to the vehicle type, age, and fuel source. So let's say you have a fleet of 10 vehicles, you may need to be using 10 different emission factors, and those emission factors could change annually. So make sure that you're using the right emission factor, you're reviewing them annually. And then, of course, you'll hear this over and over today. Make sure you've documented your sources and clearly cited them. So some emission factor sources could include EPA, eGrid. They might be supplier specific or activity specific, maybe industry specific. Just make sure that you've documented the source and then it's coming from a reliable source. Next, maintain transparent documentation. So, this is a really important one, particularly when we're talking about verification processes. Uh, this is really the key to verification that goes well for you, a verification process that goes well for you. So, I strongly encourage right from the beginning of your accounting journey to create a structured, documented data management process. Write those practices out in a manual or an SOP, or even when I support companies through this, I add an introduction tab on the spreadsheet that we use to calculate emissions that documents things like assumptions and methods, quality control practices, boundaries, and scope of what's included in the inventory. Uh, and then finally, make sure your calculation sheets are version controlled. If there's a modification that affects the prior year, you want to make sure you have a date of when that document was last reviewed so that you can make sure if there is some sort of discrepancy, you're referring to the correct version of that calculation that aligns with, let's say, your disclosure. So version controlling is a great best practice to set you up for success. Finally, conduct an audit before formal verification. This will allow you to catch issues early, ensure that your documentation is clear to an outsider, and facilitate faster, smoother third party verification. And we'll talk about this a little bit more further into our presentation. And then finally, again, implement a repeatable annual process. Greenhouse gas accounting isn't a one time practice, so make sure you're building a system that you can replicate year over year. This might include assigning clear roles and responsibilities, documenting that in your manual, creating a timeline for data collection, review, and verification, tracking any changes in your methodology, maintaining that version history, and then documenting improvements or corrections each year as you go. Now moving into greenhouse gas verification. So greenhouse gas verification is essentially any independent third-party evaluation of an organization's greenhouse gas inventory and accounting practices, confirming that the results are accurate, complete, and align with your selected standard. So there's a few reasons you want to do that. They're listed here. Again, this is what we'll dig into further as we go through this presentation, but really want to clarify our terms here that there are several types of verification. First would be an audit. So a greenhouse gas audit would be a quality check generally conducted before verification, assessing whether your organization's data, calculations, boundaries, and documentation meet the requirements of your selected standard and are ready for third-party review. Then you would move into an assurance verification. This is a formal third-party verification process in which an accredited auditor provides an independent opinion on the greenhouse gas inventory. So a couple important elements to draw out here. One, only an accredited auditor who's gone through specific training and certification can provide third-party assurance. That's why we actually use the terms audit and assurance differently. Assurance generally means that there's an accredited auditor who's providing an opinion on the greenhouse gas inventory that aligns with their expertise. Where an audit, which is something that SBC supports, really is saying it's going through a very similar process, but doesn't have that legal backing of an accredited auditor issuing an independent opinion. The other important point to make here is that the party that prepares your greenhouse gas inventory and supports accounting, if you outsource that to a third party or do it internally, should not be the same party that does an audit. And the party that does an audit shouldn't be the same party that does an assurance process. So you might have three different partners supporting you through these processes. That's not uncommon, completely appropriate. When we're talking about assurance specifically, there are two different types of assurance. One is a limited assurance. This essentially means that your auditor will provide a high level review of the boundaries, sources, methods, and documentation. This is considered a moderate confidence review. The outcome of a limited assurance verification process would be something along the lines of nothing has come to our attention that causes us to believe the data is materially misstated. This is primarily looking at processes, not necessarily specific calculations and results. Reasonable assurance, on the other hand, is much more in depth, exploring your data, your calculation processes, your internal controls, and provides a much higher level of confidence that inventories are materially correct. The outcome of this type of assurance arrangement would be a statement. Again, assurance verification outcomes include a statement similar to what you'd see in your financial assurance audits. The outcome of a reasonable assurance would be the verifier believes the data is materially accurate and reliable. So again, in a limited assurance audit, the outcome is nothing has come to our attention that causes us to believe the data is materially misstated. It's essentially saying we didn't say anything amiss. Where a reasonable assurance means that the verifier has dug into the data and is assuring third parties that the data is materially accurate and reliable. So, why might you go through a verification process? The biggest drivers here tend to be regulatory. This is pretty big news right now. SB 253. I'm still going to call this a recent regulatory requirement because most companies have not yet complied with the requirements, but it's coming within the next roughly 6 months. SB 253 and SB 251 are often kind of talked about in context together. They're actually two separate rules with two separate sets of requirements. So, SB 253 requires companies doing business in California with annual revenues over $1 billion to publicly disclose their scope one, two, and three emissions annually. This does not have the first regulatory deadline. SB 261 actually has an earlier regulatory deadline. But because this presentation is about assurance and verification, we're leading with SB 253 because this rule requires companies to undergo third party limited assurance, which will move to reasonable assurance in future by June 30th of 2026 for fiscal year 2025. So again, this is applicable to companies who do business in California. There are some very specific definitions about what it means to do business in California. That's actually reflected in California's tax code. But if you meet those requirements, you're doing business in California and have annual revenues over $1 billion, you are required to publicly disclose assured emissions for scope one and two by June 30th, 2026. Um, the inventory and emissions accounting practices should align with the Greenhouse Gas Protocol corporate standard that is part of the rule. And so first deadline is June 30th, 2026 for limited assured scope one and two emissions. Next would be in 2027 for fiscal year 2026 or calendar year 2026. Companies who meet the disclosure requirements will be required to include scope three emissions, which also need to undergo an assurance process. So if you haven't yet started accounting for your scope three emissions and you meet these qualifications, definitely encourage you to jump on that and start putting together a scope three emissions inventory and accounting practices. I also would be remiss to not mention SB 261, although that's not directly related to greenhouse gas verification. This is a rule that has a deadline of January 1st, 2026, so coming up very quickly, requiring companies doing business in California with annual revenues over 500 million. So the threshold is half that of SB 253 to publicly disclose their climate related financial risks and the measures they're taking to mitigate or adapt to those risks. The requirement here is to complete a climate related financial risk evaluation in alignment with the TCFD framework, and then publish a report on your company website by January 1st, 2026, and submit a link to the California Air Resources Board or CARB's public docket. That is not yet open. It opens December 1st of this year. So if you expect to be subject to that rule, make sure you get your report published by January 1st and upload the link to that public docket. Both of these rules are enforced by the California Air Resources Board or CARB. There are financial penalties for not complying with the requirements by the deadline. I want to say it's fines of up to $50,000 per violation. So if you miss the January 1st deadline in 2026, there's up to $50,000 fine. You would be subject potentially to another $50,000 fine for the following year. SEC was also set to enforce some similar requirements for publicly traded companies, However, this action has been stayed and is not likely to be implemented under the current administration. I'll make a note here that SEC rule was set to be applicable only to publicly traded companies, while the California rules are applicable to both publicly traded and privately held companies. Likewise, for those of you who do international business, the EU's Corporate Sustainability Reporting Directive, or CSRD, has some similar requirements. Regulated companies must report sustainability information. This is a much broader scope that's across environmental, social, and governance topics, but it includes scope one, two, and three emissions. I won't go through all of the threshold requirements, but you can see them listed here. Essentially, if you have a subsidiary in the EU that meets those thresholds, or what they define as a significant presence in the EU, defined as more than 150 million pounds in revenue in the EU for 2 consecutive years, you would be subject to this rule. The requirements include disclosure that aligns with the European sustainability reporting standards. One of the unique elements here is that it requires a double materiality analysis and comprehensive quantitative and qualitative disclosures. So, definitely some overlap with the California requirements, but much broader. This rule also requires companies to set time-bound targets for reducing absolute greenhouse gas emissions. So that means decoupled from production or activity. So it's not greenhouse gas emissions per, ton of material sold. It's greenhouse gas emissions, period. Um, and companies must include in their reports demonstration of progress toward those goals. Reports also must undergo limited and later reasonable assurance. So, some similar requirements. Um, Most US companies won't be looped into this right away. Most US based companies will have requirements that start in 2029 for fiscal year 2028, unless, again, there's a significant presence or large EU subsidiaries, meaning they meet two of the three subsidiary requirements. In that case, companies would be subject to the rule in 2026 for fiscal year 2025. We're not legal counsel, so we're not going to tell you whether or not you're subject to these standards. However, we would strongly encourage you to evaluate this with your legal teams if this causes you to think you might be a regulated entity. This rule will be enforced by individual EU member states. So if you do business in France, France will enforce this. There may be different enforcement or different implementation practices in other EU countries. It's not necessarily going to be enforced uniformly across the EU. So make sure you're paying attention to the particulars that are relevant to your company. However, while regulatory obligations can be key drivers for this, it's not the only driver. A lot of companies who are not regulated or who are not yet regulated may still want to consider greenhouse gas verification. A few drivers in this regard. If you're using CDP or EcoVadis disclosure frameworks, to name a couple, I know these two award higher scores to companies that can provide third-party verified data. So if CDP or EcoVadis is core to your ESG disclosure processes, maybe consider verification. Also, supply chain pressure. A lot of large customers, such as those regulated by the California or EU Scope 3 requirements, want their suppliers to be able to provide verified data. In this case, you may be able to get an audit versus a regulatory verification. It's worth confirming with your customer who's requesting it if you've experienced that kind of pressure. Similarly, investors are increasingly requiring verified greenhouse gas data to assess climate risk and performance, and verified emissions can, in some cases, even improve access to things like green financing or ESG linked loans and sustainable investment funds. So, again, if that's something you're pursuing, make sure you understand all of the requirements. And finally, consumers and stakeholders, like investors, are increasingly looking to verification as a demonstration of credibility and transparency. And this applies internally too. Verified data can improve confidence in your internal targets and inform your strategic decisions. You don't want to make a significant capital investment only to find out that the greenhouse gas emissions accounting processes you are relying on to quantify reductions weren't actually appropriate to your situation. And similarly, if you're not yet subject to one of the regulations, but you're getting close, having an external set of eyes can help make sure you're set up for success should you become regulated. Some of the requirements don't turn around on a dime. And so make sure you have plenty of lead time if you think you might become regulated or if you're close to any of those regulatory thresholds. So, if you think that this sounds good, you want to look for some verification, or you want to move forward, here's a couple recommendations around preparing. First, what should you expect from a verification process? First, there will be some sort of planning and scoping discussion. Likely, once an agreement has been reached, the first step will be a document review. In some situations, a site visit may be warranted. Your reviewer will review all of the relevant material and then issue a determination and corrective actions if applicable. Or if you are doing a verification process with a qualified assuring body, you'll receive a statement. So, preparing for verification, number one, we've said it many times, document everything. Make sure you've clearly defined your boundaries and methods, and that those boundaries and methods align with your selected standard. Know your significant thresholds and apply them consistently. This is misalignment between boundaries and activities are one of the common challenges we see when auditing greenhouse gas inventories. The other is inconsistent or incomplete activity data and failure to align with a significance threshold that the standard outlines. Document everything, use an audit checklist, and finally, document everything. This is the final, most significant challenge I encounter when working with companies through verification is that there's a lack of clear documentation. So make sure your documentation is developed, reviewed, and aligns with what you're really doing. A few more final recommendations around preparing for verification. One, know your drivers, know why you're going through a verification process and what you hope to get out of it. If you want peace of mind, maybe consider an external audit. If you have a regulatory driver, then perhaps you need an assurance audit. Each one of these types of audit, from internal to external to an assurance audit, come with increasing complexity and cost. So know why you're doing it and what you hope to get out of it. Make sure your accounting and inventory practices align with the relevant standards. Prepare and internally review documentation. Partner with a third party as appropriate for verification. And finally, particularly if you're a regulated entity, schedule your assurance audits and verification early to make sure you can meet that regulatory deadline. I anticipate that there's going to be a lot of companies scrambling over the next 6 months to secure an assurance auditor. And because of the specific requirements that facilitate the ability to complete an assurance audit, there are limited resources available. SBC can support you through this process. We offer greenhouse gas inventory and accounting support for scopes 1, 2, and 3. We can provide greenhouse gas inventory and accounting audits, and we have trusted partners across our network who can support verification or assurance audit as well. And if you need support outside of greenhouse gas accounting, we offer a variety of resources to support both hands-on and through our membership. If this sounds like something that you need, that sounds valuable to you, we are here to be a resource for you at all stages of your sustainability journey. So please reach out to us. Jessie, our executive director, is here today. Her contact information is on the screen. My contact information is on the screen. We welcome you to reach out for more information. And with that, I wish you a great day and let's work together to build a more sustainable future. Thank you for your time.